Alright, so in this video, I wanted to go over the Tastytrade mechanics of managing trades or option selling trades, either winners or managing losers. So right off the bat, Tastytrade recommends to manage winners, they recommend closing any option selling trade or strategy at 50%. So say you sell a strangle on Nvidia, for example, for July 16, you sell the 750 call, you sell the 500 put, you collect, let's say, $7.80, or let's just say $8 to make it simple. Well, as soon as this trade is worth $4, the premiums drop enough so that you can close the entire trade for $4, then that would be closing at 50%. You would keep a profit of $4, and that's how they recommend managing winners at 50%. So they have a bracket here for undefined risk and defined risk position. So let's start with undefined risk. So a strangle would be an undefined risk. So first thing you have to ask yourself, does the position have less than 21 days to expiration, or does it have more than 21 days to expiration? So let's take the example first where it has less than 21 days to expiration. So they're saying if IV rank is high, so if IV rank is over 30, then you close the position and you move it, you roll it forward to the next expiration cycle. They like to play monthlies only. So if you're in the, for example, June 18 expiry and there's less than 21 days to go, then you're going to roll it to the July 18 or July 16 expiry. That's if the IV rank is over 30. And if IV rank is below 30, they recommend to just close the entire position regardless of the P&L, whether it's a winner or loser or scratch. You close the position if the IV rank is below 30. Because basically when you sell options, you want to sell high volatility. That's your edge. If the edge is no longer there, you don't want to keep the position. You want to get out of it. So let's look at the example of the Nvidia strangle. So first of all, they recommend opening a trade with at least 45 days till expiration. So this strangle here has 52 days. So it has the July 16 expiry. So that's the monthly expiries for July. So it's close enough to 45 days. So this is a trade that they would probably recommend to open if IV rank is above 30. Now, to check the IV rank, I use this website here, MarketChameleon. Simply go to options, implied volatility rankings. And then you can't really, if you search by symbol, it's not going to give you this column here because you really want this column. So you'll just have to search for it by filtering. So over 1 billion market cap, and then I guess you could filter. You could filter, I guess, by symbol, and then just go look for Nvidia. I'll put 100 entries, and then I'll look for Nvidia just to see what the IV rank for Nvidia is. So IV rank for Nvidia is 16. So if I'm in this trade and I've got less than 21 days to go, because IV rank is below 30, then I would close the entire position according to the Tastytrade mechanics. So let's take an example. What would 21 days remaining look like? So let's say we open this trade. So the 750 and 500, the 750 call and the 500 put, but this one has 52 days to go. So I'm going to try to simulate as if it has less than 21 days to go. So I'm going to bring the expiry closer just to simulate that there's less than 21 days to go. So I chose a June 18. June 18 is 24 days. So let's take June 11 because that'll give me 17 days. So let's just take June 11 just to simulate what would it look like with 21 days to go. So with 21 days to go, you could see that my $8 strangle is already worth $2. So that means for sure, if Nvidia is still trading at 625, then I would have definitely closed this trade a long time ago because I would have closed it at 50%. So I would not have been in this position where I had to worry about 21 days, less than 21 days remaining. But let's look at an example where there's less than 21 days remaining and we were not able to close it for 50%. So let's say Nvidia had moved, let's say it had moved down or moved up. So let's simulate a move up. So I'm going to bring my strike lower just to simulate a move up. So let's say my initial strike was 650. So here's an example where my call side is not breached, but Nvidia moved up and came closer to my call side. And now the trade that I initially collected $8 on is trading for $12. So I cannot close it for a profit. If I close it, it's going to be for a loss. And according to the Tastytrade mechanics, because it has an IV rank below 30, then I should just close the entire position regardless of the PNL, and then look for something else that has high IV rank and sell against it. Even though if you might think of rolling it, you could actually save the trade. That's not what they recommend, because most likely because IV is not high, so the premiums that you're going to be selling, the new premiums that you'll be selling, won't be high enough to compensate for the loss that you're going to have to take by closing this. So now let me go back to my initial strikes, and let's go back to July 16. And now let's look at position has more than 21 days to expiration. No side has been breached. So if that's the case, no side has been breached, then you leave alone until 21 days to expiration. So if no side has been breached, you do nothing, you wait until 21 days, and then at 21 days you decide whether you close and reestablish position in the next expiration cycle. Maybe you will have closed for a 50% profit, or you just close the entire position because IV rank is below 30, regardless of the PNL. So my initial days to expiration was 53 days, but now let's say time has gone by, but we're not at 21 days yet. So let's say June 25th, so 31 days left. So it's not 21 days, so that's June 25th. So I'm just trying to simulate the scenario as close as possible. So you can see if the stock hasn't moved, with 31 days to go, I'm at 50% already if the stock hasn't moved. But to simulate a movement in the stock, I'm just going to bring my strike lower. And actually, I want to simulate let's start off by bringing my strike lower, let's say to 680. So you can see that I'm not at 50% profit at all. In fact, I'm at a losing position. But because no side has been breached yet, I can do nothing. I can leave it as is and just wait for 21 days to expiration. This has 31 days to go, so I don't have to do anything because no side has been breached yet. And that's what, according to the Tastytrade mechanics, position has more than 21 days to expiration, no side has been breached, you leave it alone until 21 days to expiration, because maybe while you wait, maybe things will change and then you get an opportunity to close for a profit. Now, let's look at the example where a position has more than 21 days to expiration. Undefined risk side has been breached. So you have a side that has been breached. So according to Tastytrade mechanics, if you have a side that's been breached, you want to roll the untested side closer to the money in same cycle. So let's try to simulate this scenario. So I've got more than 20 days remaining. I've got 31 days remaining, but then one of my sides have been breached. So let's say the call side has been breached. So I'm going to choose a 600, let's say a 620 call, okay? So my 620 call has been breached, and as you can see, it's trading, the trade is worth way more. So what they recommend to do in this case is to roll the put side closer to the call side. So right now the put is trading for about $1.50 if you want to buy to close it. So what they recommend is something similar to this. So you're buying back the put that is untested, that is actually profitable, and you're bringing it closer to the call side, to the call strike. Remember, we had the 620 call. You're bringing it closer to the call strike to collect more premium. So I'd be collecting an extra $22, $23, and that's going to help me increase my break even on the call side. And you don't touch the call side until there's 21 days left. And now you've got initial credit that you collected from the trade of $8 plus $23 that you collected from bringing the put side closer. So now your break even is wider in terms of the call side. Your break even on the call side is 625 or 630. I forgot which call strike we sold, plus all the credits that you received. That'll be your new break even on the call side. But yes, now there's a risk that the put side gets breached if the stock comes back down. But that's what you're supposed to do according to the Tastytrade mechanics if you want to play it mechanically and you don't want to guess direction or assume direction. So you roll the untested side closer. Now you don't have to roll it all the way up to the call side. You can roll it gradually. So we had the 500 put. You can, instead of rolling it all the way to 620, you could roll it to, let's say, 520, 540. As long as you're collecting credit and gradually bringing the put side closer, leaving room in case the stock comes back down. And if the stock keeps going up, then you keep bringing the put side higher and higher until you reach 21 days. So let's say I'm all the way to 600. let's say I brought the put side all the way to 600, and now I've collected a total of $14 plus $8 from the initial trade. So now let's say I reach 21 days. So I'm going to simulate reaching 21 days. My new put is 600. My call is still the 625 call, I believe, is what I chose in the example. So now, as you can see, now the whole position, if Nvidia is still trading above 625, the whole position is worth about $34. Now, if I had done nothing with the put side, I would have lost more. But now, by bringing the put side closer, I've collected more credits, reducing loss on this trade. But according to the Tastytrade mechanics, because there's less than 21 days to go, and because IV rank is now below 30, I'm going to have to close the entire position regardless of P&L. So let's say you had your put here, and then you have your call here that you sold, and the stock is trading, let's say right in the middle, let's say at I don't know, 600 when you first started, and you have, let's say, the 700 call, and then you've got the 500 put. As long as there's more than 21 days left in the expiration, if the stock comes down to, let's say, 495, or if it goes below 500 or goes above 700, then what you do is you bring the untested side. So let's say the call side got tested. So let's say the stock is now trading, I don't know, at 720. Then what you do is you bring the 500 put, you bring it closer. You close the put, and then you sell a new put, let's say at 650. So it'll be your new put. This way you're collecting more credits. You leave the call side, you don't move it. You don't touch the tested side. You move the untested side closer to collect more credit, as long as you have more than 21 days left in the expiration. Now let's see what they say about defined risk positions, so spreads. So if you've got a defined risk position, same thing. So if position has less than 21 days to expiration and IV rank is over 30, you close and establish position in next expiration cycle. That's assuming you cannot close for a 50% profit. And I believe even if you can close for a 50% profit, you close it and you reestablish in the next expiration cycle, as long as IV rank is above 30. If the IV is over 30, basically you can keep playing the same stock. Even if you can close it for 50%, just reopen it in the next cycle. That's if the position has less than 21 days to expiration. So here, same thing. If position has less than 21 days to expiration and you were not able to close it previously at a 50% profit, then you're still in the position. Then you can go ahead and roll it to the next expiration cycle, as long as IV rank is above 30. Now, in a defined risk position, if position has less than 21 days to expiration and IV rank is below 30, if position is at a loss, you hold until scratch or expiration. Because it's a defined risk, you already know what your max loss is. You accept it before even getting into the trade. So you shouldn't have to worry about the loss. You just wait it out, give the trade a chance to win, let the probabilities play out. So IV rank is low, below 30, position at a loss, hold until scratch or expiration. So scratch is if you sold for $1, then you buy it back for $1. That's what scratch means. Expiration basically is you just let it play out. You accept max loss, whatever happens, you accept. If the position is profitable or at a scratch, you close the position as well. You don't take any chances. If IV rank is below 30, position is profitable, or you can break even from the position, then you close the position. Now, what if position has more than 21 days to expiration? So if position has more than 21 days to expiration, you leave alone until 21 days to expiration. You don't do anything. It still has time, has not reached the 21 days, and it's defined risk, so you let the probabilities play out once again. And then once you reach the 21 days, then you decide, is IV rank high, over 30, is IV rank below 30, and then you decide. So it's interesting. I don't see why they can't do the same thing with the undefined risk position. So with the undefined risk position, if position has more than 21 days and and one side has been breached, you bring the untested side closer. So you could do the same thing here. If you've got, let's say, an iron condor, which is equivalent to a strangle, but defined risk. If, let's say, the put spread gets breached, why not bring the call spread closer? Or if vice versa, if the call side gets breached, why not bring the put spread higher? Now this is a Tastytrade mechanics. Now they've done a lot of research to back this management style. This is not necessarily my management style. I'm not even sure if there is a right approach, if there is a right or correct management style, but I'll go over my management style in a different video. But I definitely don't do all these strategies, for all these management approaches here for sure. So actually, to give an example, I actually had a put spread that I opened. I think it had 40. I think it had 45 days when I opened it. So I think it's on ServiceNow here, June 18. I opened it April 29th for the June 18 expiry. So it's about 48 days, I believe. And at some point, it was completely breached at some point. So right now the stock's at 480. I had a put spread at 470, 460. So my short strike is 470, long strike is 460, and the stock was trading at some point, I think at like 440. Here, let's look at the last 15 days. Yeah, you can see here it was trading at 450, and I'm pretty sure it went below 450. So according to the Tastytrade mechanics, because it has more than 21 days to go, so let's go back to the put spread here. So you see right now I've got 24 days to go, but when it was completely breached, it did have more than 21 days to go. So position has more than 21 days to expiration. You leave alone until 21 days to expiration. So that's actually what I ended up doing for this trade. Now, is it closable? If I look at what it's trading for right now, it's trading for about $3.20. I opened the trade for $2, so I collected $2 to open the trade. So right now I can't even close it for break even or scratch or for profit. If I close it right now, it'll be for a loss. But it's got 24 days remaining. But when it's going to have 21 days remaining, let's see what I have to ask myself. So when it has less than 21 days, I have to first see, does it have an IV rank over 30 or under 30? So I'm gonna go to MarketChameleon service. So it's at NOW. I hope it's on the list. It should be. NO probably doesn't have a market cap of over 100. So let's do over 50. And then let's look at the second page. NOW. Oh, did I see it? Yeah, there we go. ServiceNow. It has an IV rank of 0. I don't know if that's accurate. Let's go back up here. Yeah, it has an IV rank of 0. So okay, so let's assume this is correct. Yeah, that's terrible. All right, so let's assume this is correct. So basically, IV rank is low, under 30. Position at a loss. You hold until scratch or expiration. So I would still hold on to it because it still has 21 days to go, and it's a defined risk position. So I know what my max loss is. My max loss in this position would be in this trade would be $8, so $800. So either I hold, I put a good till cancel order to close it for $2, or I just accept whatever it's trading for after at expiration. The other thing I could do is, if position is profitable or at a scratch, I will obviously close it. That's according to the Tastytrade mechanics. If the trade has less than 21 days to expiration, which is coming up soon, probably at the end of this week, this Friday actually. But what I would probably add to it is, why not sell a call spread a little bit higher? Instead of just accepting the $8 max loss, why don't I turn this trade, let's say, into a call spread? Add a call spread to this trade and turn it into an iron condor. So let's say I go sell a 500, 510 call spread to turn this trade into an iron condor with the same width. I would collect almost $2.20. So now my max loss would be $10 minus the $2 I collected from the put spread and the $2 that I collected from the call spread. So now my max loss would only be $6, and my max loss would occur if the stock is above 510 or if the stock is below 460. So I don't necessarily agree with just accepting the loss and just holding until expiration. There's still some opportunity to sell the other side, the untested side, for extra credit. Now the problem, by what usually happens when you sell the untested side, or when you bring it closer, the what you just brought closer ends up being tested in the future or gets breached because the stock ends up reversing. But if you want to be mechanical, you don't want to leave credit on the table. You're breached on the put side. might as well just take action and sell something on the call side so that you're collecting credit and reducing max loss, because you cannot lose on both sides. You're either going to lose on the call side or you're going to lose on the put side. And I don't even have to go to 500. I could go to 520, let's say, and 530. That would give me probably almost $1 of credit. But I don't think ServiceNow has a 0% IVR, because I don't know, premiums seem good for me to sell 520, 530 and still collect some credits here. Although June 28 is 24 days to go, so maybe that's why. So yeah, I'm actually just gonna hold on to it and see what happens. And it's not necessarily because I'm following the Tastytrade mechanic. It's just because I think it was oversold, and I think with time it should be safe and should be above 470. But I will probably put an order on it to close it for 50% profit. So that's something I could potentially do. But I don't think I'll be selling the call spread, because from experience, every time I sell a call spread to mitigate a put spread, the call side gets breached. So I'm not comfortable selling the call spread right now. But if you want to be mechanical, that would be the better approach, instead of just holding on to it and doing nothing. All right, so just wanted to review the Tastytrade mechanics here, and I'll make another video discussing my management style just to compare. So if you have any questions, leave in the comment section below. Check out the referral links below as well. If you want to open an account with Questrade and get $50 in free commissions, link is below. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.